Hey, Think Realty, thanks so much for listening and tuning in today. It's my privilege to be the podcast host. My name is Eddie Wilson, the founder of Think Realty. Founded it in 2013. As a third generation real estate investor, I wanted to just continue to bring information and knowledge to the marketplace, and that's what we do through this podcast, as well as our magazine and all that we have going on at Think Realty. Today we've got a great guest, but before we get to the guest, I want to say a quick thank you to our podcast sponsor, which is Real Property Management. This episode is brought to you by Real Property Management. Working with the right property management company can put more money in your pocket, not less. Real Property Management provides a higher standard of property management to make sure you're maximizing the return on your investments. Experience the real difference with Real Property Management. Visit realpropertymgt.com. That's realpropertymgt.com. We've got a great guest today for you on the podcast. His name is Eric Stewart. Eric is one of our resident experts, and he's an expert in financing when it comes to commercial financing, as well as very, very specific on residential commercial financing, and has done everything from being the broker to being a syndicator. He's done all things across the board, and we're going to have a great conversation today. So Eric, thanks so much for being a part of the show.
Thanks for having me, Eddie. Appreciate it.
Glad you're here. We are live in Phoenix, where our Think Realty conference is, and so it's always nice to do these in person as opposed to, sitting over Zoom calls like most podcasts are today.
The Brady Bunch.
Yeah, very good. I appreciate you being a part of this. If you don't mind, let's start off with, I don't know, we've had you on podcasts before, but I don't know if we've ever really walked back to why you are where you are. So if you don't mind, step back and give us a little bit of an introduction into how you got into commercial real estate, what led you down that path, where did it all begin?
Oh, I'd love to, absolutely. It's in the late 90s, I did a lot of equipment leasing. I started in the credit department, actually, of an equipment leasing company. And that's really where I got a taste for just leverage in general, borrowing money. We did a lot of industrial equipment. We actually did answering machines. And I really leaned into AHOA, the Asian American Hotel Owners Association. And I financed or leased a ton of their reservation systems and built solid relationships with those folks. And a lot of hoteliers, once you build up a trust, they opened up and asked me to assist with mortgages. I had a partner at the time, and he was doing mortgages as well. And eventually, we just looked at our business profitability, return on effort, as they say, and really focused in on mortgages, on the commercial space, more so than the leasing. And that led to right about 06, 07. That's when we really focused on the multifamily space. And what interested me the most and really excited me the most were my multifamily clients were relatively new getting into the industry. And we worked together before they even had a property in mind. Right? We just talked about the available debt. We talked about what to look for, how to build projections, what lenders want to see.
Sure.
And that became my marketing efforts. Rather than focusing on bringing donuts to brokers and building relationships with brokers so you get multiple deals, understood. But for me, offering my time and industry knowledge to new investors coming into the space was that long game. And building relationships with those folks has been everything. And that was 06, 07.
Wow.
So, I formed Atlantic in 2004. And we haven't looked up since. It's been wonderful.
Yeah. What has it been like over the last few years as you've been building it? I mean, it's got to be up and down and, all over the place. Because you've had really, really hot times. You've had really, really low times. I mean, have you been able to really weather that storm since 2004? And I mean, have you ever had to diversify and kind of step out of that space a little bit, or has it been just one track and success?
There's universal principles of ups and downs in business, as you well know.
Sure.
So you well teach.
Yeah.
And that's making hay when the sun shines and preparing for the rainy day, right? So leveling out your expenses and keeping that in check relative to doing everything that you can in the up markets. Like we're not in a high volume time right now in the industry, and we'll talk about what we're doing now in the industry as well. But it's really been just keeping a level playing field on the expenses. That's from a business standpoint. Now, from a client standpoint, the debt component it could be the driving force behind making it or breaking it through a down cycle is when that debt matures or that interest only period expires and you convert and the loan starts to amortize. That can be everything to a deal.
Sure.
So properly planning that debt has been a huge component to my client's success.
And if you don't mind, explain who your client is, because I think sometimes when you and I speak, it's very ethereal. It's very much, we're talking about the deals, talking about the kind of the bigger space that we're in. But if you don't mind, like hone in specifically on who that client is.
No, that's great. That's great. It's good for me to do too, just to kind of to stay aware of it. My client avatar is it's multiple individuals, but it's an individual that is either in the single family space that wants to move into multifamily and expand their portfolio. Maybe they're doing commercial retail, maybe they're doing industrial, and they want to add multifamily to their portfolio. Or it's someone that has no real estate experience and wants to get into the business. They may not have the funds to buy their own deal. They may not have the experience to run the entire deal themselves. But that's when we lean into the individual's value and their transferable skills, what they've done in the past and how they can be part of the team. Because in this business, as in many businesses, you don't do it alone.
Right.
And it's just so broad. To be able to build a successful multifamily operation, you've got to have competent team members and everybody knowing their value. That's where the team succeeds. So just helping them realize that and what they can offer to a team has been everything.
I've always said that multifamily is one of the hardest mixtures of private equity and real estate all combined in one, along with business operations, right? It's like, think about having to, manage a multi-million dollar asset with $15 to $17 an hour employees, right? Like, it's difficult, it's not for the faint of heart. And so if you're not putting that team together, you're really working at a disadvantage.
Absolutely. And I can tell you, after the last couple of years that we've had with as far as looking at my payroll, I'd love to find some of those $15 to $17 an hour competent employees.
Yeah, well, they're hard. They're few and far between because the competent ones are just getting paid today. So
they really are. There's so much competition.
Yeah, for sure. Well, if you don't mind, let's talk just a little bit about the marketplace now. So when it comes to multifamily, there's a lot of, I would say, from my perspective, I'd love, if you think I'm wrong, see it differently, I would love to hear it. I feel like right now where we're at is that investors like me see a little bit of blood in the water, and so we're getting excited, right? Like, I'm buying deals that are 70, 80 cents on the dollar right now, even Class A's, right? Like, I'm finding good deals. However, capital is still kind of behind the curve, and it's tough to get big money to go with you. So like, even though you see the deal, it looks like you can get it at a discount, all the underwriting shows you're at a discount, it's really tough to then source your capital for these deals. And so much cash is having to be brought to the table to make your big capital feel safe, that it feels like we're in this like waiting period where it's like, the waiting period is where the big capital is kind of waiting to see if performance will actually meet the standards that we're underwriting it to today. Is that how you see it?
I see a lot of that.
Okay.
I think it varies depending on the deal size. Certainly development has stalled and the financing for development is at a low. There are individual relationships that have been built over years, well, frankly, probably decades, where that money is leveraging those relationships and finding those opportunities, like the ones that you're talking about. Understanding what you have behind you and your ability to fix whatever caused that issue. Let's say you present a maturity default, where that owner doesn't have the liquidity to make up the deficiency. Well, that's a wonderful opportunity because operationally you've got your fundamentals there. You may see another opportunity where they were at the end of their renovation cycle, and when individuals are buying, when syndicators are buying 60s, 70s assets, every 5 to 7 years you're going to have to inject new capital. Maybe it's not there. So I feel like the opportunity, and what I see is that the opportunity is what defines the availability. When they can get their heads around it and say, that's fixable, let's do it. The concern is that they're waiting for a better day, and if it's not that home run, when you talk about blood in the water, if it's not that home run, they may wait for that home run. maybe they're not the investor that you're looking for.
Right. Yeah. Very good. I know that you are a relationship guy. I know you've built your entire career on building relationships. You're not super demonstrative in your marketing or your social efforts and stuff like that. It's like, but it seems like the value of a relationship is how you've built your business. Is that true? And if that is true, what are some tips or some ideas that you have that have worked for you in the past on that?
Eddie, it's true to a fault, frankly, because I watch your strategies that you teach and you execute on, and I try and implement more of that. You know, I watch what you're doing on social, I watch what you're doing with your companies and your people, and I try and learn from that and implement it in my own business.
Sure.
But I've built more off camera, which I know you have too, obviously, but I built off camera, not on camera.
Sure.
And I need to do more of that. So frankly, I think you're true, or it's true to a fault. But what has allowed me to do that is that I've invested my time. I listen first and do everything I can to execute for that individual. I understand the consequence of what they're providing me with, what they're asking me for. If it doesn't work out, they've usually got anywhere from $50,000 to $300,000 earnest money, may or may not be non-refundable.
Sure.
So there's a consequence. They underwrote the deal with specific terms. Those terms have to align with what is eventually delivered.
Right.
So continuity from our initial consultation to closing is one, listening is another one, and doing what we say we're going to do is another. Before this call, before this podcast with you, Eddie, I was on a call with a client who's doing his first agency loan. Now, I gave him a loan amount, but I also gave him the understanding of how I define that loan amount and what could change during the process. That way he's prepared.
That's great. The market seems to have some movement in it today. I've seen, I think the last time we spoke, I talked a lot about the distressed assets that are out there, kind of those, like you were talking about, the rehab cycle's completed, they're in their lease up kind of phase, they don't have enough liquidity, so these assets are trading. You know, where are we today? I talked a little bit about that, but maybe give us a little bit more specific, like where are we today, and what are the factors that that you see on the horizon that will continue to make this industry change? And which direction is the change, I think, is what we want to talk through, because it change meaning start to pick up and see some transaction volume. Or it continues to go down. I mean, what?
And I feel like there is sufficient dry powder, like what you had talked about, that will not let this drop as far as, say, retail or industrial, or even, let's compare it to single family, you know, where one roof has one income stream. I don't feel like this dry powder is going to let it drop that far because of the competition. They're going to want to jump in and get their piece of that pie before it starts to shoot back up. So again, in our business, when our benefit or success is predicated on tougher times in the economy, where we benefit from lower rates, we may see, with all the pressures that are being talked about, it's highly likely that we're going to see rates either level out slightly lower, or, you know, see if things do get tough, maybe we'll see even better rates. What does that do for us? Interestingly enough, that really helps our business, provides liquidity to our market. And you even said on a previous podcast, we're getting involved now, that was back when rates were slightly higher, maybe 75 to 90 basis points higher. Getting involved at these rates, once rates do drop, you're going to be that much to the good on your valuation. Well, my expectation is folks are going to see that. They're going to let things level out and go through. I hate to put a timeline on a prediction. I have to be cautious about that. But I am optimistic for the end of the year. You know, you've got institutions like Freddie Mac and CBRE that are putting optimistic viewpoints out there of continued cap rate compression. I shouldn't say continued, because it hasn't been compressing. But cap rate compression this year it was in the multifamily space. And you know, rates are projected to go lower by the end of the year. So there's some positive headwinds that are moving in our direction.
I was bidding on a property north of St. Louis, the St. Charles area. It was a $70 million deal, and gorgeous Class A, beautiful, 4 years old, and just prime for the picking. And the owner was a little bit distressed and was just trying to trade the asset. And the amount, I thought I was, we were in kind of last, first invest or whatever they call it, the last phase there. And I think I was going up against one other group, it was a big institutional group. And they just kept adding more. They just kept adding dollars to it, adding dollars to it, adding dollars to it, and I just ended up getting outbid. It was pretty wild because an asset of that. There's not a lot of people that can take down an asset that's more than 30 to 40 million. Like most of the, there's kind of these tranches. It's like there's a lot of people in the 10 to 15 million dollar range. It gets a little bit slower between 15 and 30. Above 30, like you're starting to play in a little bit rare air. There's not as much competition, but this is a $70 million asset. And the guy was trying to sell 3 assets. In total is like 125 million, but the 71 was the big one. Are you seeing that bigger groups and more like that it's easier to go after the big ones because they're already established, there's already a baseline of profit and performance? And are you seeing like in any of those phases more growth or less growth?
Well, I can tell you that I have to stay in my lane. And my lane has been defined by sub $25 million deals because of my client avatar we were talking about. So we tend to stay competitive. We tend to stay in an arena where we are competitive. Maybe we don't go D1 for a $70 million deal.
Yeah.
Because of, similar to what you just mentioned, there are, let's say you come in with a $300,000 to $500,000 earnest money deposit, and it's non-refundable and you don't close.
Right.
The majority of institutions are going to consider that an operating cost because they know they're going to make it back in the next deal.
Yeah.
Let's say your overage contingency is not sufficient for your reno budget, and you're $300,000 to $500,000 over in your reno budget. They float it along.
Yeah.
Let's say your projections are slower because of flat rents, like we're seeing now, and it kicks it out a couple years. Well, their overall cost of funds is usually much cheaper than that of a smaller syndicator. So staying in our lane has been something that's really proven beneficial, and higher yields.
We
don't have to get that. We don't get that skinny on our projections because we're doing friends and family syndications. So I have to be cautious about talking about that space of 70, 100, $150 million deals. As a mortgage broker, that's not where my value is. My value is to the individual, the smaller syndicator and the individual investor. They need me. I'll just throw BlackRock or Starwood out there. They hire people on staff for me. So that's the difference between what I do and the arena that you're playing in.
It's also, I think the rarity of it is that most people don't have access to capital to raise. Like that deal I was talking about, I would have had to come up with 26 million. However you slice and dice that, whether it was a syndication or I bring additional people to the table. And but so you're saying that most of the deals you do are sub 25, and then what's the typical capital raise that you're going after for many of your clients?
The typical capital raise, I'd say most of my clients are coming in raising anywhere from, say, a couple $1 million to $6 or $7 million. Has everything to do with the deal itself. Because if we're buying a perm deal, now I'm talking about loans. If we're placing perm debt on it, there's not a huge renovation budget, and it's really more of an operational play. The raise is going to be lower. If we have to come in with reno funds, because for whatever reason we're not borrowing that money, then you're going to see that increase. But a couple $1 million to say 6 million, maybe 8 on a high side.
Any other just market trends you see today, things that are going on that our listeners should be aware of?
There's yes, actually, the trend right now seems to be something that you alluded to earlier, where you see the blood in the water and you're out looking for those types of deals. And it really seems like the offers that are coming in are deeper discounts than we've seen in the past. People they've got their head around the fact that owners need to sell for whatever reason. If it's on the market, they expect that somebody has to sell. When cap rates compress even further and people are selling just to take profits because they're realizing their plan then there's more competition for that because people aren't selling because they have to, they're selling because they want to.
Sure.
Now the expectation is people are selling because they have to when they may or may not have to. I don't think a lot of these owners are they're in desperate need of selling. Some are, it's happening, yes, but we haven't seen that.
No.
We haven't seen that hit the wall like everybody's waiting for.
Yeah.
So there's still that, we'll call it the bid-ask spread. You know, historically, what, 10%? That is wider now than it has been.
Sure. Yeah, and that's what I've seen too, is that most of the brokers are coming to us with deals. And it's very much just like, this is an opportunity, but it's the ones that I have spoken of, you know, I'm talking about the margins, you know, it's like the ones that are like, oh, I'm distressed, I need to get rid of this, you know, can you help me out? But by and large, most of the broker deals that are coming to us are tied to just an owner that's willing to trade if the market makes sense, you know? And most of them are just either trying to get back to a place of liquidity, or they've been sitting on an asset for 4 or 5 years, and it's just the timing that it makes sense. You know, like they're trying to avoid kind of that next infusion of capital that they're going to put into the deal. They can do it, but you know, if they can pull money off the table and not do it, then it's like they're willing. But right. I've found a lot of unmotivated sellers for sure in all the deals we've been looking at.
I agree. I see them as well. And the ones that are motivated, that's where it oftentimes isn't even marketed.
Sure.
They talk to the broker, and you know, the broker says, I'm going to call Eddie because he's on my short list, and then you snack up the deal. Most
of the ones that we've gotten at a discount have been a direct call. They've never hit the market.
Exactly.
You know, and we've bought, I think, 4 assets in the last 6 months, but every one of them have been off market.
Right.
And that just comes with being a buyer who's done a lot of deals, and the brokers do. They give you a call, they know that you're a buyer, and they'd rather not go through the process of listing it and taking photos and walking the property and doing all the things, you know, and they know that I've got a team that'll sit there and go through everything and underwrite it, and they don't have to actually do any of the work to do it, and they can just offload that deal and be done. So,
and that has everything to do with understanding the real value to your seller. What is the value that your seller is looking for? Is it price?
Sure.
Or is it certainty of execution?
Right.
And it's always going to be a blend of both because you've got a bare minimum, but nobody wants to take the highest offer with somebody they think can't close.
Yeah.
And so I think somebody like you that brings so much certainty of execution to the deal ends up getting that better price.
Yeah. Yeah. That's what we're on that $70 million deal that I was just talking about. We're actually hoping and we actually showed them as one of our negotiation tactics was we said, hey, by the way, this institutional buyer just missed 2 closing dates on 2 properties, so you might just be aware of that. That was one of our negotiation tactics, because essentially that's what we identified was they had a time frame that they had to close within. We were ready to do it. But the other buyer just kept going up in price. We just couldn't keep going up in price. So what we did was, instead of continuing to try to negotiate on price, we essentially tried your second route, which is, hey, we're a sure close, and they've missed 2 out of the last 2 deals that they've done. So just FYI. Yeah.
That's everything.
Yeah.
That's how you get your deals.
Yeah, for sure.
Excellent.
For sure. Cool. If you don't mind, just kind of in way of wrapping this up, because there are so many single-family investors in the Think Realty world, could you just walk them through the basic loan process, right? Like, most of them have been thinking about multifamily for years. They've thought about buying that 35 unit, that 72 unit. They've started to think about, like, how do I get to that next level? But I think that most of them don't quite understand, and because they don't have the knowledge, they choose not to take that step. So it's just a way of like passing that knowledge on to them. Will you just explain to them the loan process?
Yeah, absolutely. And it does vary from even though it's the investment world.
Sure.
The term DSCR loans it's just really bubbled up to the surface over the last 5 years. The reality is that's all we've done in the commercial space. They're always DSCR loans.
And DSCR loans, if you're not aware, DSCR, debt service coverage ratio, and based on, let's say, if you have $1,000 worth of rent coming in and the DSCR is 1.2, then you would need I'm sorry, if your mortgage payment was $1,000, you'd need $1,200 in rents coming in order to cover your DSCR, is basically what a DSCR loan is.
That's exactly it. That's exactly it. So that's one of the approaches that we use in the commercial space. And
are you seeing about a 1.2 or 1.25?
Industry standard is 1.25. That would be a national average.
Yeah.
If you get into smaller markets or markets that have limited economic drivers,
Sure.
Oil and gas is one, or maybe it's a military town. Then it's highly likely that you're going to see a 1.35, a 35% margin.
Sure.
In your top markets, then you're 1.2.
Yeah. Okay.
So that's kind of what they want to see. It's sort of a risk mitigation factor. But big picture, I always start with an initial consultation. Before you're even looking for, or before you even lock down a property, you need to know what to underwrite, especially in the debt side, because that makes up the largest part of the capital stack.
Sure.
So we walk through what the terms you should dial in, and then we walk through what your team looks like, because there are specific sponsorship requirements. Even though the loans that we do are primarily non-recourse, they still look for specific financial criteria and guidelines, and then experience. So maybe if you don't have that experience, which I'll share something that's really encouraging with you in just a second. But if you don't have that experience, you may need to bring somebody on a team and partner with somebody that does.
Sure.
So we walk through that. Typical time frame to close is about 60 days. And one of the unique things that your Fannie lenders, your Freddie lenders, and your CMBS lenders do that banks typically don't is they order the third-party reports at application. So they underwrite the borrowers, the LLCs, and the deal while the appraisal and all the third-party reports are being gathered and prepared. Whereas a bank will approve you subject to appraisal. So you get 3/4 of the way down the field, and you're approved, and then you just have to get the appraisal to support it.
Yeah.
In our world, it's day one.
Right.
So we need to do our homework up front because we're spending anywhere from $15,000 to $35,000 on third-party reports. We want to make sure that what we prepare is what's going to end up at the closing table.
Sure.
So that's a general overview of how we put it together.
That's great.
On that, the Freddie Mac thing, over the last year, Freddie Mac has opened up their guidelines for experience. It used to be 5 or more units for a couple years.
Sure.
They have opened up their guidelines to duplexes, triplexes, and quads, as long as you have a minimum of 10 of them.
Sure.
As previous experience, which is just a little note of them kind of embracing that single family investor.
Yeah, and I just realized that a couple of months ago, and it's 10 units total, right? So it'd be like 5 duplexes, or it's the actual units they're counting, which is pretty crazy.
It's the units, yeah. It's nice to see them open up to that experience.
Yeah, they're acknowledging that. Yeah, it's great. Thank you so much for being on the show today.
Thanks for having me.
Thanks for always being a part. How can they get a hold of you if they want to reach out?
Well, still the phone number and email is great, but also Facebook. You can look me up there, Eric Stewart, Atlantic Investment Capital, and LinkedIn. Eric Stewart, Learn Loans is how you'd find me on LinkedIn. The phone numbers are on the website, and I'd love to hear from you.
It's awesome. Thanks, Eric. Appreciate it.
Thank you.
All right. Well, this episode's been brought to you by Real Property Management. Working with the right property management company can put more money in your pocket, not less. Real Property Management provides a higher standard of property management to make sure you're maximizing the return on your investments. Experience the real difference with Real Property Management. Visit realpropertymgt.com. That's realpropertymgt.com. Coming up in 2025, things that you don't want to miss is on August 13th, we have the Think Realty Virtual Summit, the virtual summit. I know many of you have always wanted to come to one of our events, and we do have some amazing events with amazing content. And in order to broaden that, last year we did our very first ever virtual summit, and we've got that coming up on August 13th. It was a great time, a lot of great information, great speakers. Make sure you jump in and you sign up for that. You can go to thinkrealty.com/virtual, and you can see all that there on the website, and you can sign up. This is going to be talking about unlocking the secrets to skyrocketing wealth with top real estate investment strategies of 2025. And we're going to go through all types of real estate strategies, from multifamily to single family to all the strategies when it comes to financing and then also with tax-free investing when it comes to IRAs and investing in your self-directed accounts. So it's going to be a great event. Make sure you sign up, and we'd love to see you there. Thanks so much for being a part of the podcast today. Have a great day. Happy investing.